Hi everyone, good evening. It's my pleasure to have you today here. I have with me Shreyash Devalkar from Access Mutual Fund today. And while he needs no introduction, I'm still going to be talking about introducing him to all of you. He is clearly one of the star mutual fund managers in the country. Today, we're managing close to about 25,000 crores across various funds at Access AMC. He's the eponymous fund manager of one of the most well-known funds, which is Access Blue Chip Fund. So this is a fund that has made an entry into the Scripbox portfolio of recommended funds this year as part of our usual annual portfolio review process. So this is a fund that has made an entry into the Scripbox portfolio of recommended funds this year as part of our usual annual portfolio review process. It was a fund that merely missed it by a whisker last year, but this year clearly they knocked the doors down and they are in the portfolio. Shreyash comes from a long background of equity research and fund management. For the last 17 years, he's been involved with the Indian markets in some capacity. He's spent a long amount of time at IDFC, AMC, BNP Paribas, and now in Axis. I'd like to welcome you, Shreyash, and thanks for making out the time on a holiday, right? I know it's a Good Friday and markets are closed. And I would also like to thank all of our investors and clients who logged on to the webinar, because I understand that it's a holiday for everyone and people are taking a break from the work from home setup that a lot of us are in today, right? With the current lockdown, one of the things that I've heard consistently from friends, colleagues, clients is that the work from home period has been fairly hectic because you literally get no break from your workday, and something or the other keeps happening. So I really appreciate everyone taking out the time and doing so. I'll just take a couple of minutes to talk about our portfolio review process, which happens every year, and then hand it over to you, Shreyash, for some initial comments, right? So we at Scripbox have a regular portfolio review process. What that essentially means is that every year we review our portfolio of mutual funds and change the selection of funds if required. So what that essentially means is that possibly one or maybe more funds from our existing portfolio or of our offering will be replaced by new funds. And people who've been investing with us for a while know this, that we do this religiously every year. And the idea is to ensure that you as clients are invested in the best funds at that point in time. We have our own algorithms which look at not only the performance, but risk management and a bunch of other factors for you to ensure that your performance remains top of the line, right? Even for the last year, the markets have declined significantly. We sent out our report card earlier last month, and you would have seen that across most themes, our portfolio is down significantly lesser than what the market is. So clearly, the algorithm is working, and as part of that algorithm and selection process, one of the new funds in the overall portfolio in the large cap space is the Access Blue Chip Fund. It's a marquee fund and it's done phenomenally well over the last 5-7 years. And Shreyash, who runs that fund and a fairly large equity portfolio at Axis Axis Mutual Fund, is with us today. And Shreyash, I would maybe invite you to start by talking a little bit about the AMC itself, because Axis AMC has moved significantly over the last year, possibly one of the best years in the history of the AMC, with the AMC growing significantly, crossing the 1 lakh crore mark and closing the year almost close to 1.5 lakh crores, just a little shy of 1.4 lakh crores. And it's been a great year. So would be good for you to share a bit about the AMC, and we would be very keen to understand the process at the fund that you run, which is Access Blue Chip. What is the process, and what do you believe is the secret sauce out there?
First of all, thanks for inviting me, and good afternoon to everyone. First of all, stay safe, and I think working from home is as hectic as you are saying. In this if you just go back and look at Axis AMC, then Axis AMC is actually fairly young organization in the AMC industry. It was started almost 10 years ago. So I think among all the AMCs in India, probably this is one of the latest one, you can say. But in the 10-year itself, with the backing of strong bank like Axis, as well as on the base of the performance of these funds, the fund has come in the top 10, and now it is one of the top 10 AMC in India. Axis AMC also has investment from one of the international fund house, which is Schroders. It is a UK-based fund house and international. So they have around 24 to 25% investment in Axis Mutual Fund. So this is so we also have some products for them, and they also use our research as as a backup for their India. So they don't have an India's dedicated team. So they use us for their research purpose. Our team actually helps them. So this is about Axis Mutual Fund. Now coming to our processes, and just again going back, and that is one of the key element of the performance, I would say. Having started in 2000, again 10 year ago, around the financial crisis, at that time Mr. Chandresh Nigam, who was then CIO of this, and now he's a CEO of mutual fund. So the processes were laid then itself in terms of what you follow as a fund house. So we follow quality and growth as an investment style, and I'll get into detail of what is it about, because these terms look very generic, right? Because everywhere you see the similar stuff, but then still you will find the portfolios different. So just wanted to delve more into that, what I mean by that. But to just conclude on what has helped us in doing well is this process, because post financial crisis, not only in India but worldwide, uh, market has flocked to quality and growth as an investment style. So you notice same thing has happened in Nasdaq. So you notice same thing happened in India. Everywhere it has happened. That the traditional people have the traditional way of looking at it is high beta is equal to high return, high risk is equal to high return. But actually, on the contrary, what market has shown in last 10 years is low beta, low risk is higher and sustainable return, and that comes from this quality and actually quality and growth as a style captures it. So how it captures it, again, just wanted to get into the details of these terms. Actually, growth is self-explanatory, so I don't think there is very debate on that. What is growth? XYZ company or industry, whether it is growing faster than GDP, and in that also individual companies growing faster or not. So it is a very quantitative term, wherein one need not debate. There is no these are the objective ways of looking at company, like any company is growing or not. It is a very objective way of looking at it. The quality part is always a subjective part, wherein always one person may differ from other, one investor may differ from other, and that's where we have defined our quality. How will you define the quality? Because if you want to define quality in a qualitative manner, then you will use terminologies like value addition, moat, competitive advantage. But what next? What How does it because any company, again, you can justify by using this terminology, but most important there is again being more quantitative about it. So if you get into the quantitative aspect of quality, then, and again, in this quality discussion, I'm keeping corporate governance and interest of minority shareholder as a hygiene. So I'm not so obviously everyone looks at that, and that is a hygiene factor. But quality is much beyond that. It is not only about it. It is also about whether company and business generates return on equity, which is more than cost of capital, whether the company is full tax paying, whether company is less leveraged, whether free cash flow is closer to the PAT of the company. So these are the subtle elements of quality, because whatever English we use to determine quality by way of again value addition, moat and all, it should get translated in these numbers. If it doesn't get translated, then generally then what? Then what is the use of all those qualitative element of quality? So these are the things what we have focused on. And time and again I'm highlighting in last 10 years market has rewarded this, and that has been one of the key element of outperformance of this as a style.
Sure. Sure. Thanks a lot for sharing that, Shreyash. Uh, One of the things that that often gets uh, especially in the current kind of market people think about. And you started the AMC in 2008, which was almost a similar backdrop, right? The year was a fairly tough year, and right now I don't think that we have had a tough year. We've had a March which threatened never to end in terms of what was happening in the equity markets, and the faith of a lot of equity investors has really been shaken, especially because a large number of equity investors have come into the market over the last 5 6 years. Right, the industry, just in terms of number of people who started investing, has completely gone through the roof over the last few years. And to them, what would you want to share? Because we hear a lot of worried investors talking to us about whether this is a good time to continue my SIPs or should I just pause them. And of course, while our uh, while our point of view to almost all of them is always that eventually time in the market is significantly more important than just timing the market. And in that sense, the only way retail investors can really look at wealth creation and wealth accumulation over a period of time is by letting SIPs run on an ongoing basis. But what is your point of view? You've seen the market in cycles.
Yeah, sure. So your observations are right that the flow started has built up recently a lot. So actually, not only in 5 year, if I just go back 3 year, actually post demon, and if you take the SIP book, it has grown leaps and bounds after that, right? And somehow SIP book is one of the strongest now. It usually so almost 9,000 crore per month is one of the biggest one. So this book was built in last 3 4 years more so. Uh, Having said that, when we look at equity as asset class, what we and one of the reason for this to happen is all the alternate investment asset class which people used to choose before this. So erstwhile it was a gold majority, then either because it was a tradition or because it was a active investment, whatever is the reason, but gold has been one of the case. Then it was again substantial money also went into property. uh, and that's where your observation comes into picture of 4 5 years, wherein the property as one of the asset class has not delivered, and people saw it, and that's where some of the smart money started moving out of it, or at least incrementally getting allotted to other asset class, and that's where the equity stood out, that this asset class can generate a better return. Now, what when we say always that longer period of time, how much time you spend in the market is important. There are a couple of reasons for it. First of all, when you buy any other asset class, maybe gold or property, especially in case of property, you don't get daily NAVs, you don't get a daily assessment of it. And that's where even if probably in last 5 years, including holding cost, the value might have gone down only, right? So you don't tend to, but still people would buy it and say that okay, in 10 years 15 years it will still yield me a better return. So while in case of equity, that generally and in case of gold, it being a physical investment wherein you don't really try to capitalize it, try to monetize it, you end up holding it for long period of time and end up making it. In equities, normally what happens is it is very liquid. So based on the sentiment point at any point in time, one tend to act on it, whether to buy or sell. And most of the time, it is sell when the things are worst and buy when the things are best. And this so there are multiple analysis has been done worldwide also on this, that the urge for timing is the one of the worst thing to do in investing. because no one can time the market, because I'm sure we'll ask that question after some time, but I'll but just to borrow from that it becomes very difficult to time market for anyone, and that's where spending a lot more time and more systematically is one of the important in this. And one more important point, why in last few years, if someone would have started and there the returns are low even now, and again I would treat this as a COVID as a black swan event, which otherwise would not. So if you take this event, then obviously yes, one it has actually wiped out a lot of returns. But if you take any other event before this, they have not wiped out to the wealth to the extent it has happened now,
Yeah.
right? Only the similar event you can remember is 10 years ago. So when the returns are thin in the sense, before the 2008 crisis. So from 2002 to 2008, people used to just it was a norm that equity will give you 20% return, 15% return. People used to ask us, if your portfolio growth is 15%, then that is not really good. Actually, you should have a portfolio growth of 30%, because that was a norm. But when the returns are thin, like 12, 13, 14%, or in that sense, any sharp correction in 1 year like this can wipe out returns for 3 to 4 years. So since the return from equity has come down, and that is a fact that everyone should have accepted, that now the returns from equity as an asset class, generally it gives you return few percentage points more than the nominal GDP growth. So when nominal GDP growth is around 10, 11, in a normal term, I'm talking about, not exactly in this year, but if it is around 10, 11, you can expect couple of percentage of point here and there from equity as asset class. So when the returns are so thin,
Yes,
in 12, 13%, sorry.
just interject here. Maybe you might want to explain nominal GDP and its relation with inflation, right? Because that also.
Right. So nominal GDP is GDP plus inflation, right? And normally equity as asset class gives you return slightly more than that over a longer period of time. So since nominal GDP growth has been around 10, 11%, and so the return from equities has been around 12, 13%, and that is so this kind of return can get wiped out in a 1 year like this. When the market falls suddenly 20 to 30%, it can
Sure.
get. And that's where, when down, absolutely, more time you spend is the only recipe to make sustainable money out of it, rather than trying to act on every approach.
Fair enough. I think that's a great summary. One of the questions that often comes at this point in time is whether, given that the markets have been falling and a lot of very well-known companies have taken a significant hit uh, from their peak share prices, right? Does it just make sense to buy shares directly from the market versus investing in mutual funds? And and our submission to almost all our clients has always been that you should look at this. Uh, the entire exercise of giving money to a fund manager is all about getting a specialist to help you manage your money. Just like the way we go to doctors to get ourselves treated, we don't go to pharmacists. The same way, you just should not just flock over to the Sensex or the Nifty and just pick up stocks, because eventually your ability to take uh, decisions and be aware of where the companies are will always be limited by the bandwidth or the time or the energy that you have and interest, right? And as opposed to a professional whose whose main focus is about driving value for this for you, and making sure that your money works harder for you. Shreyash, you want to add any perspective on this or any point of view? Please feel free to add it. I just thought that I would.
Sure. I think you are rightly compared this with doctor and health. The reason being, just only one similarity. Obviously, health and doctor is much more important than a fund manager. But point is, one more important thing is, both of one should consider investment also as a serious thing. So when something happens to health, we consider the serious thing, and that's where we don't end up taking decision, and that's where we go to the doctor and probably take. So in case of investment also, it's not that. But good part of investment is, any individual also can do a serious work and then he can invest. There is no doubt on that. But the only thing is considering multiple uh, 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 activities which normally demand individuals' attention, including his job, everything else. As long as you are guided by sound advice, then one can directly take that sound advice, or you do your own work in individual companies and then invest. But based on otherwise just hearing from hearsay, I think this is good, that's why I'm investing. We don't take any tablet because I think this tablet is good, right? So having worked on it, and if you take decisions and hold on to it, it is really good in the exercise to do for anyone. But then I would just urge that, I would not say that just don't invest directly and invest only in the mutual fund. I would say whatever you are doing, if you're investing directly, take it as a serious thing rather than recommendation from any person you think that he must be doing. He has spent time, so I'm taking away his opinion and just implementing. You apply your mind, you spend some time on those companies, and then act. If you can't spend time on that, then obviously mutual funds are obviously there for to help all of us.
Sure. Sure. Thanks a lot for sharing that. One of the questions was that as long-term investors, does it make sense to switch funds on a periodic basis? I'll just take that. So the belief here is that while time in the market is important, but time in the right funds, time in the right kind of companies is equally important. So one of the things that that we at Scriptbox do is every year we look at funds, and within our selection, our endeavor is to offer you the best possible funds at that point in time. It is important that that we as investors not only stay long-term invested, but also stay in the right portfolio of products, right? And that's basically the job that we as a platform are doing for you, monitoring your investments and periodically rebalancing if required. And as your portfolio grows, coming to you the asset allocation suggestions. And both across our long-term wealth and the wealth edge portfolios, our endeavor is to ensure that your asset allocation reflects the stage of wealth and the stage of life that you might be at. One of the another question that has come by is that given the volatility in the market and the health situation, there's been a massive up and down over the last few weeks, right? And you almost wonder whether a monthly SIP frequency is enough, or somebody should look at weekly, and weekly at least for some time. And that, within that context, just to add to that, is there are some people who are sitting on a surplus, which they would look to invest in the market. How should they think about investing this money? I'll just try and just talk about the second part, and I'll leave it to you, Shreyash, to answer the first question. On this, for whatever money which is there, we typically suggest that you look at your asset allocation. Over the last few weeks, the equity part of your portfolio has taken a hit in value. So to that extent, you should try and add it back. Our recommended approach is via a stock transfer plan, which is systematically transfer plan, which is STP. Which the idea out there is that you invest on a monthly or a weekly basis, depending on the horizon that you are looking at and the kind of capital that you're looking to deploy. And of course, this window is not a small window. We hope that the window, we understand that the recovery takes time, and this window of investment from where we are to back to where it goes up, it's a long enough time for everybody to continue investing. And more importantly, it's not about when you are investing, but for how long have you stayed invested in the market. Shreyash, over to you. If on both the increase my SIP, and even if I am investing my lump sum, should I look at wherever that hypothetical bottom is and try and enter the market at this point in time?
Sorry, for the last part, I think the way I understand your question is whether SIP is better now or lump sum. That's what is the question.
No, so the question is that should I increase the SIP frequency and be weekly? On the lump sum side, the thing is that should I just look at the hypothetical bottom and try investing close to that, or I should look at
Okay. So as far as SIP frequency is concerned, generally whatever frequency you might have set, I would say that one should not try to change. That is my personal opinion, because see what when we do SIP, it is what we end up doing is a time averaging, right? SIP is a tool. It is not a timing tool anyway. It is a time averaging, but it is a discipline tool, so that you disciplinarily set aside some money and invest in the market regularly rather than using it somewhere else. It is incidentally perceived as a timing tool. It is not. It is a time averaging what you do. So once you have set up a particular time averaging, which is say monthly, then over a period of time it averages out your error, right? So there is no point in again changing on that I think now market has fallen, so let's do it weekly, and now if it goes up then I will do it monthly. I think as long as your SIPs are for 5 years, 3 years, it won't matter. uh, Unless so that's where I would not recommend to change frequency and all in this, because it is just a time averaging. You are trying to average. I always give example. Actually, there was a certain point in time in last year itself, when actually someone who would have invested lump sum made more money, and someone who would have invested in SIP would have made a negative return. So that's where don't confuse it as a timing tool. You are not timing it. You are actually doing a systematically disciplinary way. So just maintain discipline. That's what I would say, rather than trying to use it as a timing also. Now, if someone would have a lump sum and would like to do STP, again considering the current event, which is COVID event is happening worldwide and also in India, uh, everyone knows that whether the market has bottomed out or not, it depends. No one knows whether it is bottomed out or not, but everyone knows what is the parameter that will determine whether it is bottomed out or not. And the only parameter here is whether we can control COVID in 1 month lockdown, or 2 month lockdown, or in a remote unfortunate case if it gets extended to 3 months. So this is the primary thing based on which your bottom will formation, whether it is right or not, that will get. And frankly, this is $1 billion with an answer to which no one knows. Now, in this situation, that is where I would use a 4 month, 5 month, 4 to 6 month kind of STP, because then all these cases get averaged out, right?
sure.
So and globally also till now, broadly 3 month has been the case everywhere. Okay. So in worst case, I'm saying, best case obviously if we can do it in 1.5 months, well, good for us.
No, makes sense. I think given the amount that you are investing and how material it is to your overall savings surplus, you can look at a 4 to 6 month window. You can look at a 12-month window. You can even look at a 24-month window, depending on the kind of corpus that you're looking to deploy. Of course, if you're looking to deploy at a certain during the time when the uncertainty is high, so that you you get the you're able to take on the you are able to deploy something tactically, and that is where a period of even a 3 months or a weekly frequency for a while can also work out for you. Uh, One question that has been asked very frequently, and we are getting on the question Q&A slab as well, is that what is your view on the recovery path for the market? Right, we saw the market come down drastically all the way down to by almost 40%. It corrected, and last few days it's been on a mad upright again. Right, and as an investor who's in this, you are completely confused that is the bottom already over, or or has the market already recovered, or are we seeing the global events influencing the Indian markets? What is your point of view on this?
Actually, market, what it has done in last 1 month, actually market started falling even before that. But if you take just last 1 month, when actually the scare started escalating in India as well. In last 1 month, actually market is down, but if you notice in that, certain sectors like FMCG, IT, telecom, some of the energy companies, some segment of the market, all these pharmaceutical especially, these segments are actually flattish to positive in a month.
Sure.
While the financials and auto are are down significantly till now. So a section of market is up and section of market is down. So though headline index may look wherever it is, but market has recovered a lot in a section of market. So the recovery path market has already decided and charted out. You can then notice the pattern.
Yeah.
And when I explained my quality and growth philosophy, at that time I explained that low leverage, high free cash flow, good corporate governance. Now this low leverage, which I use one of the term, helps significantly in such kind of thing. So now you notice the pattern. The companies which are having less leverage are actually following the least, right? And financials being one of the highly leveraged business by design. It's not that a unnecessary, it is a design business designed that.
Yeah.
Such businesses are down, while those which are free cash flow generating, those which are having less leverage or no leverage, net cash, those businesses are up. That market has already done. Then so that is there is one level of businesses in the recovery. Because why? Because whenever this lockdown gets over, whenever normalcy starts coming back, at least this company can think of growing rather than trying to wonder how to pay interest, how to come out of this debt leverage, and then I will grow. So then entire process gets elongated to those companies, whoever are leveraged. So this is where the first level of this is the recovery pathway. The second is which are the companies which get least affected, and that's where market has actually in the recovery path has started out there. These companies which are in the pharmaceutical or any people will buy food, grocery, and everything in the FMCG. So those food items. So those companies are weak. Uh, so the rest which is down, uh, the outlook on again coming back to the earlier answer to earlier question, outlook on whether 1 month is sufficient or 2 months is sufficient or 3 months is required. That outlook and the clarity on that as and when emerges, the recovery will start in those segments as well. As I said, I'm talking other segments have already seen recovery in last 2 weeks or so. Those segments will also go ahead based on those outlook because today if you see though in city like Mumbai probably may warrant continuation, which is most crowded and anyway you have to use public transportation for going anywhere. So even if you open the city and public transportation is not working, how people will anywhere travel. But so there are some around 700 districts in India, out of which by by numbers, many districts actually would not be affected so much, and those can be opened and the rest. But then by way of contribution to tax and contribution to GDP, probably some of them may not be that big again. Uh, so those kind of things one need to look at, and that's how the recovery will also shape up. And sectorally, as I said, market has told actually already told you in the last 2 weeks recovery that how you are looking at this. Recovery.
Sure.
Always the question comes is whenever there is such a shakeout in the market, whether and especially this being so earlier financial crisis was a financial crisis. It didn't touch so many people directly, right? If you remember, it didn't touch only probably capital markets and certain segments which were too export dependent. They felt it. Otherwise, not many segments. It's the way today. Today, right from a blue collar to farmer to everyone. Everyone is getting affected by one way or other in this. So whether this incident is going to change the way of doing businesses, uh, and those are the subtle elements which are being asked worldwide as well, while charting out this path for recovery. So all these elements, apart from what I told you earlier, will form the backbone. So whether the earlier companies which have done well, whether they can come back or whether they cannot come back, the clear answer to it will depend on whether they are leveraged or not. So these are the things which we are looking.
Sure. No, thanks a lot for sharing that in great detail. I know we are already beyond the 30 minutes time that we had committed to. I'll just take one last question. I think one of the questions that has come by is that how should, given what is happening, how should investors protect themselves, and what can we uh, as the platform suggest to protect them. So one of the things that we've talked about the last few webinars and almost through all our blogs and the interactions with press or otherwise we've shared over the last few weeks is that anybody who's looking to invest right now should ensure that you are sitting on an emergency fund which takes care of all your expenses, whether one-time EMIs for the next 6 to 12 months, depending on your age and stage in career. You should look at having at a minimum of 4 times your monthly income as an emergency fund. It is only once that is established should you look at deploying anything additional to equity. This is extremely important given the uncertain times to ensure that you are not forced to redeem your equity investments and you can stay invested for the long term. Do remember that ups and downs are part of the equity journey, and it's extremely important to stay invested and continue investing through the bad times as well, right? Or rather through the tough times. There are no good or bad times, but eventually through the up or the down cycles of the market, it's extremely important to continue investing. And the only way many of us can ensure that discipline is there and maintained is by having an emergency fund that can take care of any emergencies that come our way. So that is something that I suggest to all the clients who are worried about their investments and how should they think about protecting themselves. Once your emergency fund is set, whatever else is there is essentially for the long term. And once you're looking at the long term for your long term financial goals, whether it is your retirement, your kids' education, or anything else, your horizon should be long enough to benefit from whatever cycles and the opportunities of wealth creation that the market offers. With that, we'd like to call it a close. Thanks to you, Shreyash, for volunteering your time and introducing our clients to your process and sharing your wisdom with us. I'd also like to thank all our clients who took out the time on a holiday to join us for this session. Thanks everyone. Okay, with this, we'll like to close it.